There's a number I want you to keep in mind for the next few minutes. $8 trillion. Not invested in stocks, not sitting in real estate, not in gold, not in oil, not in crypto, not in any of the assets people argue about on the internet. Just sitting, parked, in something so boring most people have never even heard of it. And I think this number tells us something really important, not just about Wall Street, not just about rich people and hedge funds, but about where this economy is actually headed, and what it means for your money specifically, whether you have $100 saved or $100 million. So let me explain what's going on. First, let me set the scene. It's March 2026. The US and Israel have just conducted airstrikes on Iranian oil infrastructure. Oil prices spike. Inflation fears return. Investors start dumping stocks and looking for the safest thing they can find. And here's what's weird. Normally, in a moment like that, people run to gold. Gold is the oldest fear trade in human history. When things get bad, when empires fall, when wars start, when currencies collapse, people have bought gold for literally thousands of years. It's physical. You can hold it. It feels real. But this time, people didn't run to gold. They shunned gold entirely and ran to something called money market funds instead. And the result? Total assets in US money market funds hit a record $8.27 trillion. In just 1 week, $49 billion poured in. And on a single Tuesday, the day after the Iran strikes, $18.5 billion came in alone. One day, $18.5 billion. Into one specific type of financial product most people couldn't even explain if you asked them. So what is a money market fund? And why does any of this matter to you? Let me explain money market funds in the most human way I can. You have a bank account. Your bank pays you maybe 0.01% interest, 0.1%. You put in $1,000. A year later, you have $1,000 and one single dollar in interest. Meanwhile, your bank takes that same $1,000, lends it to someone else at 7 or 8%, and keeps the difference. That's the deal you agreed to when you opened your account. You probably didn't read it. Nobody does. A money market fund is basically a way to cut the bank out of that deal. Instead of your bank taking your money and lending it out, a money market fund takes your money and buys short-term government debt directly, treasury bills, things that mature in days or weeks or months. And because there's no bank in the middle taking a cut, you get most of the yield directly. Right now, after the Fed's rate cuts through late 2025, that's somewhere between 3.5% and 4%, which compared to 0.01% at your bank feels almost absurdly good. And here's the other thing about money market funds. They're liquid. You can get your money back fast. It's not locked up for years like a CD. It's not tied to some contract. You put money in, you can take money out, basically whenever you want. Safe, accessible, pays a real return, backed by the US government. If that sounds too good to be true, it isn't, really. There's a trade-off, and we'll get to it. But first I want to explain why $8 trillion is in these things right now. Because the size of this number is genuinely unprecedented, and to understand it, you have to go back a few years. Money market funds exploded in popularity starting in 2022, when the Federal Reserve began hiking interest rates aggressively to fight inflation. Before 2022, interest rates were basically zero, had been for years. Money market funds paid almost nothing, like 0.1%, 0.2%. Nobody cared about them. They were just a place institutions parked cash temporarily between investments. Then the Fed started hiking, and hiking, and hiking again. By mid-2023, the Fed funds rate was between 5.25% and 5.5%. And suddenly, money market funds were paying over 5% a year, risk-free, backed by the government. No lockup period. For the first time in a decade and a half, cash was actually competitive with stocks. You didn't have to take the risk of the stock market to get a real return. You could just sit in cash and collect 5%. So people did. Institutions moved money in. Retail investors moved money in. In 2025 alone, money market funds attracted $935 billion in new inflows. Retail investors accounted for 34% of that. Institutional investors made up 64%. And then something strange happened. The Fed started cutting rates in late 2024. Returns on money market funds started falling. The Fed cut again in December 2025, bringing the target range down to 3.5% to 3.75%. Normally, when returns fall, money flows out. People chase higher yields elsewhere. That's just basic human behavior. We go where the returns are. But the money didn't flow out. Analysts expected inflows to slow significantly in 2026, but they're still projecting another $500 billion coming in, pushing total assets past $8.6 trillion by year end. That tells you something. People aren't in these funds purely for the yield anymore. They're in them for something else. They're in them because they're scared. Let me show you just how unusual this moment is. If you look at the history of money market fund assets going back 20 years, you see a pretty clear pattern. Assets would build up during periods of uncertainty, then drain back out when confidence returned. They were a temporary shelter, not a permanent address. After the 2008 financial crisis, assets peaked and then started declining as markets recovered and people moved back into stocks. After COVID hit in 2020 and markets crashed, money poured into money market funds, then left again as the recovery took hold and the stock market roared back. But since March 2022, when the rate hikes began, money market fund assets have grown by over $1 trillion and have not stopped growing. Even as rate cuts came through in late 2024, and even as the stock market hit multiple record highs during the same period. Read that again. The stock market was hitting all-time highs, and people were still piling into cash. That doesn't happen in a normal, healthy, confident economy. When stocks are going up, money chases stocks. It's one of the most reliable patterns in financial history. People are greedy. Returns attract capital. That's how markets work. Something is different this time. And I think understanding what is different is the most important financial question most people aren't asking right now. One financial analyst put it this way: when you have times of dislocation and times of fear, cash is the only thing that makes sense to a lot of people because there's the belief that you simply can't lose by holding it. That phrase, "you can't lose by holding it," is the key to understanding everything, because technically, mathematically, that's not quite true. And the gap between how cash feels and what cash actually does is where most regular people get hurt. Here's what I mean. Inflation right now is running at somewhere between 3% and 4%. Your money market fund is paying roughly the same, let's say 4%. So you're roughly keeping pace with inflation. Your purchasing power is staying flat. You're not losing, but you're not gaining either. Meanwhile, the stock market, despite all the fear, despite all the uncertainty, has historically returned somewhere around 7 to 10% a year on average over long periods of time. So the question isn't just, is my money safe in a money market fund? It is safe. The question is, safe compared to what? And for how long? If you park $100,000 in a money market fund for 1 year at 4%, you have $104,000. If that same $100,000 had been invested in a broad stock index over the historical average, you'd have roughly $108,000 to $110,000. That's a $4,000 to $6,000 difference on $100,000 in 1 year. Now multiply that over 5 years, 10 years, 20 years. The difference stops being a rounding error and starts being the difference between a comfortable retirement and a stressful one. But here's where it gets really interesting and really uncomfortable. The reason people flee to cash during scary times isn't irrational. It feels extremely rational in the moment. Markets are volatile. The news is bad. Wars are starting. The economy feels unstable. Of course, you want to protect what you have. The problem isn't going to cash. The problem is what happens next. To successfully time the market, to go to cash and then come back in at the right moment, you have to be right twice. Not once, twice. You have to pick the right moment to get out. And then you have to pick the right moment to get back in. Most people get the first part right, or at least feel like they did. Getting out when things look scary is easy. Fear is a powerful motivator. Your gut screams at you to protect yourself, and you listen to your gut. The second part is where it falls apart, because going back in requires the opposite of fear. It requires confidence. It requires looking at a market that maybe just dropped 20% or 30%, with headlines screaming about recession and crisis, and saying, okay, now is the time to buy. Nobody wants to do that. It feels insane. At the bottom, when prices are cheapest and returns from that point forward are historically best, the world feels most broken. And so people wait. They wait for things to feel safe again. And things start to feel safe again when prices have already recovered, when the headlines have turned positive, when their friends are talking about how much money they're making, and by then, most of the gains are already gone. There's a famous piece of data that illustrates this brutally. If you had been fully invested in the S&P 500 over the last 20 years, your returns would have been substantial. But if you missed just the 10 best trading days over those 20 years, 10 days out of more than 5,000, your returns would have been cut roughly in half. 10 days in 20 years. And here's the part that makes this especially painful. Those 10 best days almost always come right after the worst days, right in the middle of the panic, when everyone is most scared, when cash feels most safe. The people hiding in money market funds right now, they're not stupid. They're not irrational. They're just human. And being human is expensive. Now I want to address something that I think is actually the most misunderstood part of this whole story, and it's a bit counterintuitive. You'll hear a lot of financial commentators say things like, there's $8 trillion sitting on the sidelines, and when it comes back into the market, prices will explode. The idea being that all this cash is just waiting to pour back into stocks and real estate and everything else, and when it does, it'll be like a dam breaking. That's actually not quite how it works. And understanding why is important. For every seller, there is a buyer. If one investor sells their stocks to go into a money market fund, someone else has to be buying those stocks. The money doesn't disappear from the market, it just changes hands. When money market funds eventually unwind their treasury holdings, other investors step in to fill that space. The cash isn't on the sidelines. It just flows from one investor to another as assets change hands. So the story isn't simply $8 trillion comes flooding in and prices go up. It's more complicated than that. What the $8 trillion really represents is a collective mood, a posture, a disposition, and that posture is defensive. 42% of financial advisors now expect a less healthy economy in 2026, the highest reading all year. These are professional money managers, people whose literal job is to understand economic conditions and position capital accordingly. And nearly half of them think things are going to get worse. That is the signal, not the dollar amount itself, but what the dollar amount reveals about how the smartest money in the room is feeling. Let me tell you about the other shoe, the one that nobody is talking about very loudly yet. The Federal Reserve has projected the Fed funds rate declining to about 3.4% in 2026 and roughly 3.1% by the end of 2027. And as rates fall, money market fund yields fall too. They've done so in lockstep during every previous rate-cutting cycle, which means the 4% return that's making cash attractive right now is not permanent. It's already shrinking. In the last two major rate-cutting cycles, money market yields plummeted, falling from over 4% down to under 1% within a year or two. So here's the scenario that I think is genuinely underappreciated right now. Rates keep falling. Money market funds go from paying 4% to paying 3% to paying 2%. The original reason people fled to cash, that 5% risk-free return, evaporates. And now you're sitting in something that's barely keeping up with inflation, while the stock market is doing its thing, while real estate is doing its thing, while everything else is moving. And at some point, you have a choice. Stay in cash and slowly watch inflation eat your purchasing power, or get back in and accept the risk you were trying to avoid in the first place. This is the trap. And it's not obvious from the inside. Because the transition happens slowly, then all at once. There's one more thing I want to address, because I think it changes how you should think about all of this. We've been talking about this like it's an abstract economic story, but let me make it personal for a second. If you have any money in a 401k, in a retirement account, in any index fund, you are affected by this story. Not because your money is in a money market fund necessarily, but because the people managing billions of dollars in institutional capital are making decisions right now that will move the markets you're invested in. Financial advisors describe money market funds as serving multiple purposes right now: emergency reserves, near-term spending needs, dry powder, and a volatility buffer when markets feel unsteady. That last phrase is interesting, dry powder. That's the term investors use for cash they're holding specifically to deploy when opportunities arise. Cash they're not done investing. Cash that's waiting for a signal. $8 trillion of dry powder. When that signal comes, whether it's a peace deal in the Middle East, a Fed pivot, a clear resolution to the tariff wars, some portion of that $8 trillion is going to move quickly into assets. And if you're already in those assets when that happens, if you stayed invested through the fear, you benefit from the rush of capital coming in after you. If you fled to cash waiting for safety, you might be the one buying from the people who held through. That's the dynamic that plays out every single cycle, every single time. The patient investors sell to the scared ones on the way down and buy from the impatient ones on the way back up. So where does this leave you? I'm not a financial advisor, and I'm not telling you what to do with your money. That's not what this is. What I'm saying is this: $8 trillion sitting in money market funds is not just a finance story. It's a story about fear, about how fear manifests in a modern economy, about how the very tool designed to protect you, cash, safety, certainty, can, over time, become its own kind of risk. The people who moved into money market funds aren't wrong. The product is sound. The yield is real. The safety is genuine. But there's a version of this story where $8 trillion in cash is the most expensive mistake that a generation of investors makes. Where the fear that felt so justified, all the wars, all the tariffs, all the uncertainty, turns out to have been the noise surrounding a signal that said, stay in. And there's another version where the fear was entirely justified, where the bottom hasn't come yet, where that $8 trillion is the only thing standing between the people who hold it and a much worse outcome. The honest truth is, nobody knows which version we're in. Assets have hit a record and the number keeps climbing. Smart money is cautious. The world is genuinely unstable in ways that aren't just vibes. There are real wars, real inflation pressures, real debt problems that haven't been resolved. But history has a pretty clear verdict on what happens to people who wait for certainty before they act. Certainty doesn't come. The world is always uncertain. The question is never whether it's risky to invest. It always is. The question is whether the risk of investing is greater or smaller than the risk of not investing. 8 trillion people just voted for the risk of not investing. Whether they're right, we'll find out together.